Something is breaking inside the housing market right now. Housing market crash 2026, real estate trends, mortgage crisis warning. And it's not what you think about rising interest rates or falling home prices. Everybody's watching interest rates in the U.S. housing market. Everybody's waiting for prices to come down in real estate. But while all of that is playing out on the surface, a much bigger problem is quietly spreading from city to city across this country. Homeowners with 780 credit scores, the safest borrowers in America, are now defaulting on their mortgages at a rate that has surged over 300% in the past year alone. These are not reckless buyers. These are not people who overextended. These are people who did everything right, and they're still going under. And it's getting worse. Foreclosures just spiked 57% in a single month. In Lakeland, Florida, 1 out of every 145 homes is already in some stage of foreclosure. Cape Coral, Jacksonville, Cleveland, even Washington, D.C. just saw the largest inventory surge ever recorded in that market after tens of thousands of federal workers lost their jobs. But here's the part. Almost nobody is connecting. The force behind all of this isn't mortgage rates. It's what happens after you buy the house. The hidden costs of homeownership just crossed $16,000 a year. Insurance alone is up 70% in 5 years. And Fannie Mae and Freddie Mac just quietly changed the rules on what kind of insurance you even need. And the reason they did it tells you exactly how desperate the situation has become. Now, I'm also going to show you what's happening right now in Canada, because what their homeowners are going through is essentially a preview of what's heading our way next. And if you own a home, if you're thinking about buying one, or if you're trying to sell one right now, you need to see this. So, let's start with what's actually happening with mortgage delinquencies, because these numbers just came out, and they tell a story that the mainstream media is completely missing. The Mortgage Bankers Association released their Q4 2025 survey, and the overall delinquency rate hit 4.26%. Now, on its own, that number doesn't sound scary. But here's what makes it different this time. For the first time in 2025, delinquencies went up across all 3 major loan types at the same time: conventional, FHA, and VA. All 3 moving in the wrong direction together. That hasn't happened in years. FHA loans are getting crushed. The hardest delinquencies hit 11.52%, the highest since 2021. And Intercontinental Exchange, which is one of the largest mortgage data companies in the country, has been calling FHA and VA delinquencies the canary in the coal mine for the broader market. But here's the thing. The canary already died because Vantage scores, credit data shows this isn't staying at the bottom anymore. Delinquencies went up across every credit tier. Subprime, near prime, prime, and even super prime. That 300% surge I mentioned, that was borrowers scoring 781 to 850, the best of the best. And I want you to really think about what that means, because there's a misconception out there that if you have a good credit, you're financially safe. That's not how it works. Your credit score doesn't measure how much money is in your savings account. It doesn't measure whether your property taxes just jumped $200 a month. All it tells you is whether you've been paying your bills on time up until now. And right now, people who have been paying on time their entire lives are hitting a wall because everything around the mortgage payment got more expensive all at once. Now, the question is, where is this actually turning into foreclosures? And the answer is going to surprise some of you because it's not just the usual suspects. But before I get into those cities, I also need to tell you about something the government just did in response to all of this that is going to make the situation significantly worse in the long run. We'll get to that first. The foreclosure map. The Adam year-end report just dropped. And here's the headline. Over 367,000 properties had at least one foreclosure filing in 2025, up 14% from the year before. Bank repossessions specifically, meaning the bank actually took the house back, up 27%. But forget the annual number for a second. What matters is the acceleration. December 2025 alone saw filings jump 57% year over year. January 2026 continued the trend. That's now 11 straight months of annual increases. This thing is not slowing down, it's speeding up. So where is it hitting? Florida is ground zero. Lakeland has the worst foreclosure rate in the entire country. 1 in 145 homes. Cape Coral, 1 in 189. Jacksonville, 1 in 200. Orlando, 1 in 217. The state overall has the highest foreclosure rate in the nation at 1 in every 230 homes. And I'm going to explain exactly why Florida is getting hit so much harder than everywhere else in a few minutes, because it connects directly to the hidden cost crisis I mentioned at the top. But Florida isn't alone. Cleveland has the worst rate among any metro over 1 million people and the highest zombie foreclosure rate in the country. Nearly 10% of foreclosed homes are just sitting there, vacant, with no one maintaining them. Chicago led the entire nation in bank repossessions. Las Vegas is at 1 in 210. Manhattan hit a 15-year high. The Bronx jumped 35% in a single year. And then there's Washington, D.C. After 120,000-plus federal job cuts, housing inventory in the D.C. metro surged over 60%. The suburbs around Gaithersburg and Frederick saw unsold homes spike 68%. Think about that. In less than a year, one of the most stable housing markets in the country became one of the most distressed. That's how fast this can happen when the economic foundation shifts underneath the local market. And what D.C. is going through right now is a warning for any city that's overly dependent on a single employer or a single industry. Quick thing, if you're getting value from this breakdown, hit the subscribe button and notification bell. We do deep dives like this every week with real data. All right, let's get going, because now we need to talk about the force that is actually driving all of these numbers. So, here's the conversation nobody is having. When people talk about what's wrong with the housing market, it's always mortgage rates this, home prices that. But the real crisis, the one that is pushing even financially stable homeowners past the breaking point, is the cost of keeping the house after you've already bought it. Zillow put out a study that pegged the total hidden costs of home ownership at $16,000 a year. That's maintenance, insurance, and property taxes combined. And those costs have gone up 76% since 2017. Let me put that in perspective. If your income went up 20% over that same period, you're doing better than most people, but your carrying costs nearly doubled. That math doesn't work. And eventually, the math catches up. Now, the single biggest driver of this is insurance. The Dallas Federal Reserve, not some random blog, the Federal Reserve, released a study showing premiums are up 70% nationally since 2019. And in Florida, it's a completely different planet. The average Florida homeowner pays over $8,300 a year. In parts of South Florida, you're looking at $15,000 to $22,000 a year just for insurance. And at least 10 insurers have either left the state or gone bankrupt since 2022. So, not only are costs going up, there are fewer companies willing to cover you in the first place. And here's the data point that ties this whole story together. Intercontinental Exchange found that homeowners in the highest insurance cost bracket are at least 22% more likely to fall behind on their mortgage. The Dallas Fed went even further and projected 203,000 additional mortgage delinquencies per year going forward purely from insurance increases. So, when I showed you those foreclosure maps a minute ago, this is the engine behind those numbers. People aren't defaulting because they can't afford their mortgage. They're defaulting because they can't afford their mortgage, plus everything else stacked on top of it. And it's not just insurance. Hopes in South Florida went from $567 a month in 2019 to $900 in 2024. High-rise condos in Miami-Dade now average over $1,900 a month in HO8 fees alone. That's basically a second mortgage. After the Surfside structural reform laws, condo owners are getting hit with special assessments that can run six figures. HOA-related foreclosures nationally jumped 50% in 3 years. This is why 7 of the 15 worst price decline cities in America right now are in Florida. It's not just a housing market correction. It's the entire cost structure of owning a home in that state collapsing on people. And remember how I said the government just made a move that's going to make this worse? Let me show you what they did. So on March 18th, the FHFA, that's the agency that oversees Fannie Mae and Freddie Mac, reversed a major rule. Previously, if you had a mortgage backed by Fannie or Freddie, and about 70% of all mortgages in this country are, you were required to carry full replacement cost insurance, meaning if your house got destroyed, insurance would pay to fully rebuild it. That rule is now gone. Borrowers can use what's called an actual cash value policy instead, which is roughly 25% cheaper. Now, here's the cruel irony of this. This only applies to conventional loans backed by Fannie and Freddie. If you have an FHA loan, you're locked out of this completely. FHA loans are governed by HUD, which has its own separate insurance requirements. So, the borrowers who need this relief the most, lower-income buyers, first-time buyers, people with smaller down payments who are already getting crushed by these insurance increases, they don't qualify. FHA delinquencies are already at 11.52%, and those borrowers get nothing from this policy change as of now. On the surface, that sounds like relief. And honestly, for a lot of homeowners struggling with premiums, it will lower their monthly costs. But here's the trade-off that is not being talked about. An actual cash value policy pays you the depreciated value of what was damaged. So if you've got a 15-year-old roof and a hurricane takes it off, you're not getting a new roof from insurance. You're getting what a 15-year-old roof is worth. The gap between what insurance pays and what it actually costs to rebuild can be $10,000 or more. And here's the kicker. Fannie Mae's own previous internal analysis warned that these cheaper policies could lead to incomplete repairs, increased debt, and home abandonment after disasters. So, what they've done is lower the short-term cost and shift the long-term risk onto the homeowner. And the next time a major hurricane hits Florida or the Gulf Coast, a lot of people with these policies are going to find out the hard way that they can't afford to rebuild, which means more distressed homes hitting the market, more foreclosures, more downward pressure on prices in exactly the areas that are already struggling the most. Classic Band-Aid over a bullet wound. Drop a comment below and tell us what you think about that policy change. And while you're at it, let us know what your biggest housing cost increase has been over the past couple of years. Insurance, taxes, HOA. We read every single comment, and it helps us understand what's actually happening on the ground in different markets. Now, here's where we want to zoom out and show you the bigger picture. Because everything I've just described, the delinquencies moving up the credit ladder, the costs crushing the middle class, the government scrambling with quick fixes, all of this has already played out in another country, and that country is Canada. In Canada, mortgages don't work like they do here. Most Canadian mortgages reset every 3 to 5 years, and right now, roughly 60% of all outstanding Canadian mortgages are up for renewal in 2025 and 26. That's over 1 million fixed-rate mortgages worth $300 billion that were originally locked in when rates were 1 to 2%. Those homeowners are now renewing at 4 to 5%. Average payment increases 20%. Some are seeing 40% or more. And the result? Exactly what you'd expect. Near-prime borrower delinquencies in Canada surged 31% nationally. In Toronto and Vancouver, 55%. Equifax Canada described it as financial stress rapidly spreading from subprime into the established middle class. Canada's banking regulator just warned that up to 150,000 borrowers may not be able to refinance over the next 2 years. Now, you might say, okay, but that can't happen here because Americans have 30-year fixed mortgages. And for most existing homeowners, that's true. They're protected. But here's what people are missing. That same kind of payment shock, it's already happening to hundreds of thousands of Americans right now. There are homeowners across this country who took out adjustable-rate mortgages 7 to 10 years ago when rates were low. Those 51 ARMs from 2016, they've been adjusting for years now. The 71 ARMs from 2018 and 2019, those are hitting their first adjustment as we speak. Data from Intercontinental Exchange shows 328,000 ARM borrowers have already passed their initial fixed-rate period and are actively adjusting in a rate environment that is dramatically higher than when they signed their loan. Someone who clocked in at 3.12% could now be sitting at 7 or 8%, depending on their cap structure. That's a payment shock that a lot of families just cannot absorb, especially when you stack it on top of everything else we just talked about. The insurance increases, the tax increases, the HOA spikes, all of it compounding at the same time. And on top of that existing wave of resets, new ARM usage just hit its highest level since 2008. 21% of new mortgage originations are now adjustable rate. Among loans over $1 million, nearly half are ARMs. That's $1.7 million homeowners who've taken out ARMs since 2019, with over 100,000 more resetting in the next 12 months alone. And the borrowers taking out these ARMs aren't doing it because they want to. They're doing it because it's the only way to afford the payment. That's not confidence. That's desperation dressed up as a mortgage product. So, we don't just have a future problem building, we have a current problem that is actively getting worse. An older wave of ARMs already adjusting and squeezing families right now. A newer wave of ARMs about to adjust over the next 1 to 3 years. And all of it landing on top of a carrying cost environment that is already pushing people with perfect credit into delinquency. This is why the Canada comparison matters. Not because their system is identical to ours, it's not, but because the pattern is the same. Financial stress starts at the bottom. It moves to the middle, and by the time everyone realizes it's spreading, it's already too late for a lot of people. So, where does all of this leave us? Let me land the final piece of this, because the affordability picture right now is what makes everything I just showed you so much worse. Housing affordability just hit its worst level ever recorded. The Atlanta Fed shows that 47% of median household income is now required just to own a median-priced home. The standard threshold is 30%. The price-to-income ratio nationally is sitting at 5 to 1, which essentially matches the 2006 pre-crisis peak. The National Association of Home Builders calculates that 75% of American households cannot afford a median-priced new home right now. And renting is now cheaper than owning in all 100 of the largest U.S. metros. First-time buyers, their share fell to just 21% of all purchases. The lowest, since tracking, began in 1981. The median age of a first-time home buyer at 40 years old. It was 28 in 1992. Home prices are already falling in nearly 100 metros. Austin down over 23% from peak. Cape Coral down 20%. Oakland down 24%. 4 cities have completely erased their pandemic-era gains. Inventory is surging across the Sunbelt Belt. Raleigh up 54%. Las Vegas 43%. Miami 40%. Now, I want to be clear about something. This is not 2008. Total foreclosure volume is still 87% below the 2010 peak. Lending standards are far tighter. Most existing homeowners are locked into historically low 30-year fixed rates. But what we are experiencing is a different kind of breaking point. It's not a credit crisis, it's a carrying cost crisis. The mortgage payment stayed the same, but everything around it kept climbing. And for a growing number of homeowners, even ones with excellent credit, the total cost of ownership has crossed the line of what they can sustain. But here's what I always come back to on this channel. Every market correction creates a window for the people who are prepared. If you've been patient, if you've been saving, if you've been watching from the sidelines because the math didn't make sense, the math is starting to shift. More inventory, more price cuts, more negotiating leverage. And the longer these carrying costs keep climbing, the more sellers are going to be forced to come down on price just to move their properties. The people who win in markets like this are the ones who understood what was happening before everyone else figured it out. And if you're watching this video right now, you're already ahead. Look at you. Make sure you're subscribed, because we're going to be doing city-by-city breakdowns, showing you exactly where the biggest opportunities are and where the biggest risks are hiding. And if you don't want to wait for the next one, check out this video right here.